We're here to talk about the Silicon Valley real estate marketplace ending the week of March the 13th, presented on Saturday, the March the 14th. The reason I have March the 15th up here is that is my normal comparison date. So when we get into the 10-year median, it's one day in the future. So today I'm going back 36 days, including tomorrow, which is zero information. So that's why it's the 15th. That's not a typo. If you want to learn more how to get the handouts and stuff, go to chapter 6, slide 60. These are the chapters we'll be going over, the associated graphics. We're in for about a 45-minute presentation. Let's get into the first data slide. Here we're looking at three major components. We're looking at the turnover rate. That's the purple line. You can see it's been climbing. We're now at about 127% of the normal. We're taking about 25%, 27% longer than normal to sell the inventory one time. It's a theoretical number. It's how quickly the market's turning over. That would be assuming no new listings and this rate of sales continues all the way up until there's no listings available. Clearly a theoretical comparison is how quickly do you turn over your grocery store products. And we would, in this particular example, we would turn everything over 24% longer than normal. So a little bit slower than normal. Moving on to the next one, and that's offers accepted. We've turned around and climbed down a little bit. We're now about 89% of the normal level. So we're missing about 11%. But look at the huge improvement we've had just this year. Here's the peak of 2022. Ever since the 2022 price correction, which you can see happened here much earlier than most people say, I have pegged it at about Valentine's Day of 2022, which again, I still think is earlier than people think. It depends on whether you look at the first peak or the second peak, but there's a lot of other indicators that go into this too. But ever since then, we were doing like 70% of the normal volume of sales for 2023. Then in 2024 and 2025, we basically did 80%. So you can see anything around 90% is sort of the highest levels we've been at. So we're still missing some of the marketplace, but we're still doing better than we have been. And the third and final component on this graph is the active inventory. And you can see active inventory has been growing. Earlier this year, right at the beginning part of this year, we were missing 20%. So we had a 20% shortage. We currently have about a 16.5% surplus, more inventory than you would expect for this time of the year comparing the same weeks. Here now is a summary going back 13 weeks. So the current data, the purple line is the current data. It ends in the middle of the graph, which is labeled this week. That's Friday night, midnight. You go back one quarter to give you some idea what the market's been doing. You go forward, but only on the trend data. The trend data is the same week for the past 10 years, the median of that. So it's the average of the middle two numbers is what it boils down to. So you can see that on turnover time, we are approaching the blue line. We're pretty close to the blue line, frankly, but we've been there now for 2 weeks, and even 3 weeks ago, we were fairly close. But it's at a fairly flat plateau, so you don't anticipate any major changes. Moving on to marketing time, you might think these are more closely related than they are, but they really aren't. Marketing time only counts successful sellers, where turnover time includes the unsuccessful sellers because they were active inventory. Where marketing time, I'm only looking at the offers that were accepted. How long were they on the marketplace? You can see we were doing better than normal, almost on top of the red line for several weeks. We actually increased slightly on the purple line from last week. You can see the level was here and now it's up here. At the same time, the gray line came down. So although we're exactly normal, in fact, we're slightly faster than normal. We're at 97% of the speed you normally would expect, and that's 16 days. So 3 out of 4 sellers are selling in 16 days. What that really turns out to be is 50% of the people come on the marketplace and basically sell after a week, plus or minus 7 days, a little bit. And then everybody else, we're looking at the median of those, the 50% of the marketplace that doesn't sell that first week. And then they're right now taking a little bit over 2 weeks. The longest you'd expect for this time of the year is 29 days. So even in a slow marketplace in Silicon Valley, it's still fast paced. 4 weeks to sell 3/4 of your marketplace is pretty rapid. Price reductions. Now they're slightly larger than normal. You can see the price reductions were right on normal back here 2 to 4 weeks back, but now they've come down and we're a little bit larger price reductions. This could be more frequent or the same frequency and larger price reductions because it's the average. And a fair number of sellers do their homework correctly. So the number of sellers that are actually doing the price reductions are fairly insignificant, and that's on the frequency, which is not on this summary chart. But you can see that we normally, or right now, we're taking 0.5% reduction, 0.53%, call it 0.5%. Typical, we're only 1/3 of 1% price reduction. So we're actually 55% more price reductions than normal. But again, the magnitude you're talking about is so small, which is one of the reasons later in the slide, one of my favorite slides is what's the 97th percentile doing? What's the sellers that are taking those largest price reductions doing? Overbidding. Now we're flipping over and saying, what's the buyer doing? How much pressure is the buyer feeling when he's out there? And that's actually come up from last week. Now, keep in mind, this is a lagging indicator. This is where the market was 3 to 6 weeks back in time, because that's when the offers were negotiated. But you have to wait for the sale price. So this is grouping closings together, not offers accepted. Marketing time, price reductions, that's grouping offers together. So it's a better indicator of what the market's doing right now. But you're pretty close to typical. It's a little bit higher than typical. Normally, you're at 6.6% overbidding. Right now, you're at 7.7%. So you're 1.1% more overbidding than normal. And that's just raw count. So on $1 million property, that would be, if I'm doing my math quick on the fly, which is dangerous, is the $11,000 higher overbid than you'd expect. So right now, instead of being $1,066,000, it's $1,077,000. And in a real competitive market place, it's up to 12% for this time of the year. And in a passive, slow marketplace, it's 3%. And that's something to keep in mind. Even in a slow marketplace in Silicon Valley at this time of the year, buyers overbid 3% based on the last 10 years. Offers accepted. You can see there's a decline in offers accepted. Is this significant? It's hard to tell. Keep in mind, back here, all last year, we were down here right on top of the blue line. That was that 20% of the market we were missing. We were back up and we were at 90% right back here. And even last week, I think we were close to 90. And even this week, we're close. We're at 89%. So when you've been at 80% for 3 years, the fact that you peaked at 92%, I think it was, now you're back down to 90%. I'm not willing to say that the market's turned yet, but it is a cautionary tale. And we've had some world crises going on that you might think the market would pull back. I would actually say that I'm surprised that the market hasn't pulled back more. And I've looked at even daily data that maybe I'll pull up in a second here. I'll finish this slide and then try to pull it up. It's going to take a few minutes to do that. But it's all over the place and you really can't make heads or tails out of it. So I was concerned about it just like when I was at the tariff concern, and there was no real impact on the tariff side as far as I could tell on the sales volume. Let me pause and pull up that graph that I was to mention real quick. Here's a graph that I threw together. This is simply the sales based on 1 week compared to their 10-year median. Basically, it's noise and you can't really see anything. And that's why I normally use a longer 5-week period of time. It's up and down all over the place. Yes, we did come down. We lost several percentage points in the last week, but the week back was an increase, and the week before that was essentially flat. I'm not comfortable saying there's any impact. We're still at above where we've been for the last 4 years, pretty much. You're not at the record because you have these peaks, but so far I'm looking for any reasonable sign that the breakout in hostilities over in Iran has caused us impact on the real estate marketplace, and I'm simply not seeing it. Inventory, you can see inventory is leveled off a little bit at this week from last week, and it's normally still increasing. We're 10% more inventory than we normally are with 2,000 listings. And again, this is for Silicon Valley, which is Santa Clara, San Mateo, and Alameda counties. And then lagging indicator up here more just because that's what the industry runs on is transactions. Right now, we're at 88% of what we're doing. So here's a summary chart of the different metrics. You have on the left-hand side, the raw count. You can see there's a lot of red, which would tend to say Silicon Valley is normal. But then come over here and look at the green. See how blue and green and yellow that is? Basically, you're saying it's an average marketplace. So even though the market's on fire over here, because everything's fast-paced, it's actually fairly normal for Silicon Valley. And then you have the percentage of normal. You have basically normal inventory because you have sort of the pastel colors. Alameda County actually has a shortage of offers of 81%, so they're missing 19% of the marketplace. San Mateo County's got 4% surplus, and Santa Clara County is missing 8% of the marketplace. Active listings, Santa Clara County has 23% more inventory. San Mateo has 37% more, and Alameda County has 10% more. You can see that we're not off the scales in any way, one way or the other. I also brought in the different metrics down here at the bottom for you. So you got the range. My shades of red are from 7 to 42 days, which is from 1 week to 6 weeks. 6 weeks to 11 weeks is your gray, your balanced marketplace. and anything over 11 weeks is favoring the buyer. And you can go across and look at the different metrics. And I believe I got everything worked out on my colors that I mentioned last time. Default is not to go from 42 from red to neutral color right off the bat like that. And that's actually green on this graph. They normally expect it to happen over a range. And that's why I was having step functions issues. Anyway, here's some definitions you can read on your own. Here's the first micro market area. This is the turnover rate. This is the speed. How quickly do you theoretically sell the market one time? You can see Fremont's absolutely the hottest area that's popping up on the screen. The most normal area is the expensive areas on San Mateo County coast. Most of the areas are red in color. That's saying you still have a fast-paced market. And this is just raw count. The exception to that is the Livermore, Dublin, and Castro Valley are this blue color. So they're taking a long time to turn over. What are they taking? They're taking 118 days. Now we're going to compare immediately to normal. So this is comparing to that 10-year median. You can see that the bulk of Santa Clara County, the center part, is cooler than normal. So that means it's taking a little bit longer. Fremont, Redwood City is all normal. Foster City, a very small micro market area, is cooler than normal, which would be longer than normal. Palo Alto is faster than normal. So you can go through and see the different metrics and look at the percentage over on the right-hand side of the screen. Marketing time. This is how long is it taking 3 out of 4 sellers to sell? Just on an objective level, it's a red hot sellers marketplace. All of Silicon Valley is selling out in 16 days, Santa Clara County 14. The long area is 19 days. So for 3 out of 4 sellers to sell in under 3 weeks, that is fast pace. I mean, you listen to people that talk about the nation numbers, and they're talking about 3 to 6 to 9 months being normal, and that's months, not weeks. And this is the marketing time compared to normal. So you can see now it's almost all greens. There's a couple hot spots down here. Saratoga Los Gatos is faster than normal, shorter marketing time, Redwood City, but very normal marketing times for this time of the year. You can see Silicon Valley is 10% longer than normal, as Alameda at 22%. So if you're in Alameda County, you're taking a little bit longer. So both San Mateo and Santa Clara County are at exactly 100, but within each county, there's a range. In Santa Clara, it goes from 75 days in Saratoga Los Gatos all the way up to a high of 126 in South County. That's a good example of why I believe it's important to look at micro markets instead of countywide data or regional data. Here now is the price reduction. So these are the sellers reducing their own ask price before the offer comes in. This is just raw count. You can see that it's pretty balanced. The Cupertino, Sunnyvale area is hot. It's an increase. So sellers are raising their price 1/8 of 1%. So that is a hot marketplace when you're going up. Here's compared to normal. You got some blue areas, you got some green areas, you've got some red, blue, light pink areas. So it's basically fairly balanced. Silicon Valley overall is at 100%. San Mateo County is at 103. That's your largest price reductions. And then Santa Clara County and Alameda County are at 99%. Here's the frequency. So we talked about this briefly, and I didn't have the graph on the summary chart, is how common are price reductions. Look at this. Silicon Valley is 9%. That's 1 in 11 sellers are doing a price reduction. So that means 10 out of 11 sellers are not adjusting their price at all before the offer comes in the door. The major exception you can see out here is the San Mateo County coast, where 1 in 3 sellers is taking a price reduction. That's a lot of price reductions. Here's frequency compared to normal. So you can see Half Moon Bay is bluer than normal. So the 33%, you can see most of Alameda County is bluer than normal. But if you look at Santa Clara and San Mateo County, they're basically fairly balanced. And San Mateo County comes in at 84%. So 15% fewer sellers are doing a price reduction. Santa Clara County is a little bit on the other side at 10% more. Alameda County is at 25%, almost more sellers doing price reductions. Here's the overbidding. So what are buyers doing? And this is just raw percentage. It's not a percentage of the percent. It's like, for example, Cupertino at 10%, $1 million home, they're coming in at $1,100,000. They're coming in 10% over the ask price. The lowest area in Santa Clara County is South County, 1/10 of 1% overbidding. And the Cupertino that I mentioned was the highest. In San Mateo County, you mentioned go from 0.9% up to 9.6%. So the range is roughly the same. But look down here at Berkeley, and I don't understand why Berkeley and Alameda County have been so much overbidding for so long. I mean, maybe I don't work that marketplace. That's too far north for me. but I mean, it's been there for probably a year or two. I could go back and look at it. I don't understand why sellers just don't raise their price. At 20% overbid, you're asking $1 million. That means you get $1,200,000 for your property. And that's just way overbidding. I mean, it shouldn't be that high for that long, in my opinion. Here's the compared to typical, and see Alameda County or Berkeley and Alameda. That's only 4% more overbidding than normal. So normally you're 16% overbidding. And that's based on 10 years. That just doesn't make sense to me. But it's clearly what's happening up there. You can see the other numbers are much closer to 100% because of the normalization. Right now, Saratoga Los Gatos is also very close to that 104% overbidding compared to normal. You can see the hot spots in the red. The cool spots are in the blue, and that's compared to normal. Here now is looking at the frequency of overbidding. So how common is overbidding? You can see overall 70% of the sellers in Silicon Valley are getting overbidding, 68% in Santa Clara County, 68% in San Mateo. More overbidding in Alameda County, and that's a constant theme, is even though Alameda County's got the longest marketing time and the most price reductions, it's got the most overbidding. That's because sellers reduce their price below where the market is. Buyers are still willing to come in and overbid after that price reduction. Here's the frequency of overbidding. So how common is overbidding compared to normal? I was going to say, I can't believe 100% of people are overbidding. So you basically have a little bit of shortage of overbidding in Santa Clara County by 4%. The other two counties are closer. Alameda County is missing 1%. San Mateo County is slightly over. You can see the different colors. Here's offers compared to normal. Now, just raw count, which is on the summary table, isn't useful because each micro market area is a different size. But when you compare to normal, now it becomes normal. So it becomes useful. So you can see that Cupertino's got 12% more offers, but then flip over and you got several areas here that are basically at 80%. And then you have South County that's only 2/3 of the number of offers that it normally has. And then in San Mateo County, Redwood City's the shiner at 10% more offers than normal. And then on the low side, you have, 76? Looks like Foster City, Redwood Shores at 77%. That's pretty small. Coast at 79%. That's pretty small. So really, though, I mean, even Atherton's small. And that's one of the problems when you have a small county and you're trying to break up reasonable properties. Here's the active, same concept. I don't have the raw count on this slide, just percentage normal. You can see Santa Clara County, a lot of areas have 50% more inventory. Basically, the heart of Santa Clara County is running roughly 50% more inventory than they normally do. Saratoga, the expensive areas, Saratoga, Los Gatos, Los Altos, Palo Alto, actually have a shortage of inventory. You go into San Mateo County, Redwood City's got a surplus. And again, the expensive areas have a small, but still a shortage of inventory. And in Alameda County, as you notice, several of the slides I don't have the micro market data for. This is long-term appreciation since the last 9 months of 2015. You can see the areas that have had the most appreciation, sort of the central part, Santa Clara, Campbell, Willow Glen, Cambrian area of Santa Clara counties had the highest appreciation, and it's at 12, almost 13%. That's real appreciation. I will also point out you have this artificial appreciation. Look at Santa Clara County. It's basically saying it's at 18% appreciation, and that's what the media would report on countywide data. Prices are up 18% from if they picked 2015. And that's huge because that's 117% appreciation. That's doubling your money. But when you look at the micro market areas, most of these areas are below 100%. How do you explain it? Remember Saratoga, Los Gatos, and Los Altos, Palo Alto, the expensive areas were still doing well. They're bringing up the median price because they're more expensive homes. So that brings up the median without impacting individual property values. And then you come down to Alameda County, and it's only at 75% appreciation, which is in line with San Mateo County. So Santa Clara County is getting a real shift in the micro market areas. You can see that the 72% is almost believable for San Mateo County. You do have the coast, but those are small that are way below, but you have 3 areas that are higher than the 72% for the county. And for Alameda County, it's also believable because there's only a couple areas below. There's 3 areas below, but they're big. Oakland makes up a big percentage of the Alameda County marketplace. Now on price, instead of just following the median number, which is the middle number, I follow the sandwich with 10 percentile on the left-hand side. That's the least expensive home you'd expect to find in a given area, and also the most expensive 90 percentile in a given area. So once you know the price range, you're in, you can find out what areas work, or if you're locked in on a particular area, you can see what percentage of the marketplace would fit into your budget. Here's the summary. And so here you can see the raw count for the number of offers to give you some idea of when I first started this back in 97, I was trying to get 200 properties in every one of my micro market areas. You can see right now, the only one that has 200 is Santa Clara, Willow Glen, Campbell, Cambrian. Most of those are under 100%, really true in San Mateo County where they're really small. You know, Foster City have 10 listings, the coast at 15 listings. That's why those marketplaces really don't count. You want to include them. You don't want to completely ignore them because you want to have some benchmark, but you have to sort of weigh the indicators of that because the randomness of real estate and the variation is so great. You need that large data set. And if you don't have a large data set, there's not much you can do. Statistics is for a large volume of data, trying to get a handle on what the market's doing. Here's some data for the next segments. So what we're doing now is we're looking at Silicon Valley in the purple. The gray, the red, and the blue lines are the 10-year medians. The gray's in the median, the 10%, this would be the blue, which favors the buyer, which for turnover time would be a long-term overtime, and that would be the 90 percentile. And the red would be the fast turnover time or the 10 percentile. So you rapidly look at the turnover that happened about 3 weeks ago. Now, that doesn't time perfectly with the start of the Iran conflict, but it might in the fact that a buyer could TFT a transaction that started shortly before and just walk away, or maybe they had contingencies and they used the contingencies to get out of the contract. So it is worth paying attention to, but again, it's not to the point where it's clear to me that there's a connection. You also keep in mind where we've been. We were at the blue for a good part of last year. We were slower than normal through this segment. We were way above the blue here. And that was before the tariffs, because you started coming up here, tariffs, if I remember correctly, were like April 17th or something like that, which would be slightly after this vertical gray line here for first, second quarter. So I'm not sure there's a cause and effect. I know everybody's looking for the cause and effect, but I think there's less than people would think. Time will tell. Turnover on a percentage basis, you can see it's hard to stay on the scale, and this is blown out, but you got this week data, you got last week's data, you got the weeks before data. So you're going back at least 4 weeks before when the real turn happens. Here is simply the marketing time. Marketing time is taking a turn up, but now keep in mind, this is 1 day. This is going from 15 to 16 days. And this could have been right at the cusp of being at 15 days. And this could be right at the bottom of the cusp, going back to 15 days. You can see that there is step function in it, especially on the 10 percentile. You can see where increments, because it's going to be hard to increment by less than a day. Yes, in theory, you can do it right when you're averaging two numbers that are right next to each other and you end up in the midpoint, but that doesn't happen very often. But again, you have reasonable marketing time. Your marketing time is right there with the gray line, which is what you'd expect for this time of the year. Here's the percent versus typical. Time yourself as a typical seller. So this is a percentage of the time. So you can see that just a couple weeks ago, we were selling at 40% of the time, and now we're back up to 100%. That's a huge change, but remember from the graph before, a lot of that was because the typical came drastically down at this time of the year, where in 2026, we came down earlier. So there was a time shift. Here's the graph that I like is what are the sellers that are taking the absolute highest price reductions? What are they doing? And that's the top 2.5%, the 97.5 percentile. Right now, they're taking a 9% price reduction. That sounds like a high number, but look, just last year, you were up here at 16%, which starts to be real significant numbers when you're talking about $2 million median pricing. Here is your ask price frequency. You can see you went from a little bit less frequent price reductions to slightly more frequent price reductions, and that's basically in the last couple weeks. Here's on a frequency basis. Now you can see the turn here looks like it's about 4 weeks ago. Here is looking at overbidding. What are the buyers doing? They're overbidding through the roof. I mean, 4 weeks ago, talking about a change, they were bidding 100%. Now they're bidding 5%. And this is the median bidder. And this is, I think, the only graph in my presentation where I talked about the median overbid. So right now, the most recent closings, half the buyers paid more than 5% over the seller's ask price, half paid less than 5%. Just a few weeks ago, that number was basically, they were paying the seller's ask price at 100%. That shows you how much the market changes so rapidly. But again, this is a lagging indicator. This is where the market was 3 to 6 weeks ago. Here's the overbid compared to normal. And this is just a raw count. So right now, the overbidding is basically 1.25% more overbidding than normal. I don't remember what the number, I think it was 6.6 to 7.7, maybe something like that. And that's about the right magnitude for this to be about 1.25. That would be 1.1%. So you can see buyers have been increasing their overbidding, but again, there's a lag factor, and that's based on the median. This is the frequency of overbidding for Silicon Valley. So right now, you're right at the normal overbidding, which is basically about 69% of the sellers getting more than their asking price. Here's compared to normal. You can see slightly below at 98% of the sellers getting. That means you're normally 2% more of the sellers would be getting overbid, very, very close. Offers accepted, you can see that it rolled over. Now, here's where you can start saying maybe there's a change in the marketplace. Because see the gray line, that's where you'd expect the market to go. The market was pretty much on the gray line. And just the last couple of weeks, it looks like it's rolling over. So there's not a huge impact this graph would suggest, but there might be some impact recently. Here's the active inventory. Active inventory is actually climbing faster than the gray line, which would mean either more sellers are coming on the marketplace or fewer sellers are leaving the marketplace, increasing the number of properties on the market. Here's my price model. Look how quickly we're going up in price. But keep in mind, this is the time of the year where we normally get overshoot. Look at, even though I say the prices have been flat for the last 4 years, you have the peak up here, you have the valley, you have the peak, you have a valley, you have a peak, you have a valley, you have a peak, you have a valley, you have a peak coming up. I missed that valley. I did a valley early. So there's a change within every year. Here's comparing Santa Clara County to 3 counties. Santa Clara County is the blue, San Mateo is the orange, and Alameda County is the gray. So this is marketing time. Clearly, Alameda County's got the longest marketing time. Santa Clara and San Mateo are pretty fast at just about 35 days. Typical time to sell this is at 3/4. Santa Clara County is the fastest at 14 days. San Mateo County 16, and Alameda County is the longest at 19 days. Price reductions. Alameda County is doing the most price reductions. That's 0.6%. Santa Clara and San Mateo are right there at 0.5%. Again, Alameda County is taking the biggest. Frequency. Alameda County is the most frequent price reductions at 11%. Santa Clara County is at, I'll call that 8.5%, and San Mateo County is at 7.5%. Here's the average overbidding. Alameda County. Remember, it was the slowest, the most price reductions, et cetera, et cetera. Most overbidding, 9.5%, 9.75%, almost 10% overbidding. San Mateo County, 7.5%, and Santa Clara County, 6%. How can I possibly explain it? It's like I said earlier, the sellers in Alameda County are on the market long enough that they're reducing their price. They're reducing it below where it triggers the buyers to come in, and then the buyers come in and overbid the reduced price. Frequency of overbidding. You can see that the most overbidding is happening in Alameda County. We already explained why, and then Santa Clara and San Mateo are exactly tied at 68%. The offers accepted. Santa Clara County's got the most offers happening. Alameda County's in second place. San Mateo County is always going to be in third because it's a smaller county in size and population. And active inventory, again, same reason. San Mateo County is going to be the slowest. Santa Clara and San Mateo, Santa Clara and Alameda are very similar. Alameda County had more inventory and less offers, so it clearly has a longer turnover rate, as we saw, than Santa Clara. Here's the long-term appreciation. Santa Clara County has the highest rate of appreciation, but remember, I already explained that's a phantom appreciation. It's because of the market mix. The more expensive the homes are selling. Here now is the price on log paper. You got Santa Clara County, looks like it's higher than San Mateo County. We'll verify that on the next. And Alameda is the more affordable. And yeah, so San Mateo County is, it looks like about 1975 on the price, 1,975,000. And Santa Clara County shot up to almost 2.1 and probably 2,075,000. So Santa Clara County is $100,000 more expensive right now than San Mateo. That never happened before the pandemic. It's happened a couple times since the pandemic. 100,000 swing with Santa Clara County being on the top, maybe the largest number. I don't know. I had to verify that, but it looks to me like it could very well be the largest price delta. Here's the payments. Payments went up because house prices in Santa Clara County went up. They went down in San Mateo County because San Mateo County prices went down, even though interest rates went up by almost an 1/8% on the national average. Here's a table, and this is another metric. And look at the bottom. You only have 1,988, and this number's going to go down. You're not going to get down to 1,812. So we increased from the 7th worst month fewest number of offers to the 8th lowest. So we're basically the 2nd lowest. More significantly, we're now the 23rd out of 25 slowest number of offers accepted. So again, that's noteworthy. Here's the raw accounts for Silicon Valley, Santa Clara, San Mateo, and Alameda counties. You can pick the metric that's most interesting to you. I actually have 2 appreciations. Here's the 2020 appreciation. So that would be basically since the pandemic, which is where Santa Clara County really shines compared to the others. And then in the overall appreciation since 2015. Here's some customizations that I do when the consumer decides to work with me as a buyer's agent. I give you commute time and distance, school ratings and or names, and key characteristics and links to maps, and then links to the details. So you can prioritize which properties you go take a look at very easily. We have been talking about the Silicon Valley real estate market. We will continue to talk about the Silicon Valley real estate market, and we'll finish up the 45-minute presentation with about 8 minutes on the Greater Bay Area, 5 regions, 13 counties. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers here in Silicon Valley and single agency transactions. Appreciate subscriptions and likes. If you want the handout, it's a 73-page PDF. You can type in the long Google Drive link here, or type in the shorter green root URL, the letter H for handout, 2026-0314 for today's date, which is Saturday, the 14th of March. And you'll get the 73-page slide presentation. You get all the content with about 100 less slides. I think the total thing is 170 slides. So I knock off 97 slides by getting rid of the movie slides and a few other selected slides. If you want to join the live presentation Saturday morning, type in the green root URL, the year 2026, or you can type in the blue link from Zoom directly. And don't forget to include the password in the URL, or you can join with the meeting number and the password, and there's the password if it asks for it. Or you can go to the YouTube archive, and that's the tiny URL, or you can go to the blue YouTube link. Here are some key definitions of the distributions that we'll be going over next for Silicon Valley. So that's, again, limited to the 3 counties. This, which is the distributions. Here's marketing time. We're starting off on the dotted line. We're stepping through a week at a time. You're going to be seeing you're climbing slowly. So we're basically at the fastest time we are for the year. And you can just see that climb, steady climb up. We're now at the end of May. Now we're into June. That might be, the peak's coming up. A couple more slides. Maybe right there, July 26th was sort of the peak. Then you have a little bit of a plateau. And now you're going to drift down. So that's an improvement. And that's the start of the major drift down, September 20th. There's the bottom, just a short-lived October 18th. And keep in mind, I only have data for every 2 weeks here. And now you're slowing down for the end of the year. You can already see that slowest marketing place right there is going to be the longest on January the 3rd. And January the 10th, it's probably on the 3rd, but I don't have that data. Look at the steepness of the slide over here. That's telling you that the market's improving. And the next slide is going to go down. See how flat it is? So the market's already degenerating, slowing down, even though the line jumped down. And now you're here. So you're already off the fastest pace for the shortest marketing time for the year. Here's the same concept on largest price reductions. Keep in mind, I'm going from the 97.5 percentile down to 82.5 percentile. So I'm looking at 15% of the marketplace shifted down by 2.5% to get rid of fluky cases and data entry errors. Same concept stepping through. The dotted lines are a year ago. So you can see that you're basically taking the least amount of price reductions. Price reductions are going to increase for the next several months. We can start, we're now at the end of May and we're still reducing when we're probably hitting a little bit of a plateau, but now that's probably the bottom. That looks like the bottom on July the 12th. Now you have a slight plateau bouncing around, really hasn't changed much. And now you're going to see an improvement on September 20th. See how the line jumped up? Now you're going to go up again right there on the 18th. That's going to be the hottest peak. So again, it was about a month-long peak improvement. And then you coast down for the end of the year. The price reductions happened earlier. This is November 29th, basically Thanksgiving, where it basically plateaus And then on January the 3rd, again, it started improving. And now you're getting up right there is probably the hottest, least amount of price reductions. And then you start taking larger price reductions. So right around Valentine's Day was the least amount of price reductions. Overbidding, this is what buyers are doing. So you can see that 5% of the buyers are overbidding by 35% or more. You can also see that 5% of the buyers are coming in, what's that, about 7% below the ask price. So you can see, and where it's flat right here on 100%, that's where the sellers, the buyers that are offering exactly ask price. We're stepping through, the purple line is the current data. We're starting on the dotted line, which is exactly 1 year ago. And this is where I'm using the March 15th. You can see you're basically over plateau. And that's where it start marching down on April 19th. You can see that it's slowing. You're getting less overbidding. You can see the line shifting down towards the blue line. Remember, there's a lag between 3 to 6 weeks on this data. That's about the bottom right there, August 23rd. And so the market actually bottomed out earlier than that. Now you can see the march up where you're getting more and more overbidding. And right about there, November 15th, the middle of November, sort of the hottest the market got, which is a month later, which then ends up with that October 22nd that I was having earlier. And there's sort of the bottom of the marketplace, the coolest, and that was January 24th. And again, I don't have January 31st data because I jump every other week. And then you're heating up, and there we are now. So what do I expect? I expect the data to stay where it is now before it cools down. Now we're moving on to the Greater Bay Area, which includes 13 counties and 5 regions. The 5 regions are over here. The counties, the 13 counties are listed by each region. And then the key definitions, we're going in along with the chapter, the page number that we're on. Here's turnover time. This is the theoretical number of how long it takes to sell all your existing inventory one time at the current rate of sales. It includes sellers that aren't successful because they count as inventory. The fastest region is Silicon Valley at about 38 days, followed closely by San Francisco and Marin, the cities, at roughly 40 days. Then you jump up to the North Bay and Central Valley at a tie at about 58 days of unsold inventory or turnover time. And then finally, you have the Central Coast at about 67.5 days to sell their inventory. So that's between 7.5 weeks to sell your inventory in the Central Coast. Here's marketing time. Now, this is different in the fact that this only counts successful sellers. If the seller doesn't get an offer accepted, I never look at their days on marketplace. So it's how long does it take 3 out of 4 sellers to get an offer to accept that offer? The fastest region by far is Silicon Valley, and it's sitting there at 16 days. The cities is at 23 days. Central Valley is at 46 days. Central Coast is at 53 days. And in last place is the North Bay at 56 days to sell there for 3 out of 4 sellers to sell. Now you have ask price reductions. These are the ask prices that the sellers reduce their ask price in order to get the offer in the door. It's not what they reduce their price when an offer does come in. It's what they've done to get that offer to come in on their own. So they're reductions in ask price. And with all statistics, it's not 100% accurate because there's ways to do a price reduction without it being triggered. Simply time your price reductions with when you relist a property. You delist a property, relist the property at a due price. Unfortunately, the only way to do it relatively quickly is to track it by MLS number. So these are price reductions that happen within the same MLS number, not over the life of the property address. But with that being said, the Silicon Valley takes about a 0.5% price reduction. San Francisco and Marin is a little over 0.8% price reduction. Central Valley is about 1.15%. Then you go down to the North Bay, which is just about 1.6%. And the most price reductions, the largest price reductions, is the Central Coast at 1.9%, just shy of 2% price reductions. Here's the frequency of those price reductions. So the least frequent in Silicon Valley, about 9% of the sellers are doing a price reduction, which would be about 1 in 11 sellers. Then San Francisco and Marin comes in at 11%, which is about 1 in 9 sellers. And then you have a 3-way tie, believe it or not, with the Central Valley, the Central Coast, and the North Bay all coming in at somewhere around 26%, just over 1 in 4 sellers doing a price reduction. Here's the average overbid. So now we're flipping over and sort of seeing what the buyers are doing. And by and far, the absolute highest overbidding is in the cities, which is San Francisco and Marin at 12% overbids. Now, there are micro market areas, as I pointed out, probably Berkeley and Oakland is somewhere around 20% overbidding, but that's just a small micro market within Alameda County, within Silicon Valley. So that doesn't impact this data, but it gives you an idea that you can be way up here in micro market data. And then in second place is Silicon Valley at just shy of 8% overbidding, about 7.75%. Then you have North Bay at about 1% overbidding. Then Central Valley at 0.5% price reduction at the time the offer comes in the door, and Central Coast at a full percentage reduction when the offer comes in the door. So this is the final sale price, the settled out price being 1% below the current ask price when the offer came in. Frequency, how common is it? Overbidding, most common in Silicon Valley at about 69%. Then the San Francisco and Marin just shy of 68%. North Bay at 43%. Central Valley at 36%. And then Central Coast at about 28.5% of the sellers are getting more than their ask price. This is the number of offers accepted. This is just raw count, so it's not that useful because each county, each region has their own population size. But Silicon Valley has the most popular listings right now at 2,000. They're all increasing, and that's sort of the takeaway. Then you have North Bay and Central Valley very close together at about 1,800 listings, and all 5 regions again are increasing. Cities at about 400 listings, Central Coast at about 375 listings. Active inventory, you can see the active inventory is higher with less sales in the city, in the Central Coast than in the cities. So the cities would have a much faster turnover time, and it did. In fact, I think the turnover time was the fastest in the cities. It might have been second fastest. Silicon Valley is selling about 2,200 listings. So it's got 2,200 listings and it's selling 2,000. So it's got a little more than 35 days of inventory available. And then you have the North Bay and up in the gray and the Central Valley in the yellow at just shy of, or just over 2,800 days, 2,800 for Central Valley and 2,900 for the North Bay. Here's the long-term appreciation. So the cities is doing the least well. It's actually right now tied for the North Bay because North Bay has come down and the cities has gone up. But overall, you can see that cities has come down to the bottom of the pecking order, and that happened with the pandemic. Silicon Valley has the highest appreciation, but as I pointed out earlier in the presentation, that's in large part because Santa Clara County, Saratoga, Los Gatos, Los Altos, Palo Alto, the expensive areas, and I believe also Atherton, Menlo Park, the expensive areas in San Mateo County, were making up a greater percentage of the market share, which raises the median for the counties and the Silicon Valley, well, without impacting individual property values. Second highest is Central Valley at about 86% appreciation, Central Coast at about 76% appreciation, and we talked about the two-way tie. Here's your prices. The most expensive region is the cities up here at about 1.875. Silicon Valley is about 1.7. Central Coast is at about 1.1 million. North Bay is at about 750,000, and the Central Valley is at about 535,000. Here's the monthly payments using the high balance conforming loan limits for the nation for the last week, which was 6.11%. Here's your raw numbers. You have each county, you have each region in bold, and I also have the Bay Area because the media talks about it so much. You have the current raw count, the change from a week ago, and the change from 5 weeks ago. And again, that sort of wraps it up. We've been talking about the Greater Bay Area. We've proceeded out with the Silicon Valley real estate market area. I'm not seeing any unmuted mics. Take care. Thanks for joining. Bye for now.